Hello, everyone. Happy Wednesday. This is Simon with AvaTrade. Welcome to our weekly webinar, Interactive Trading Conversations. And we're starting our weekly webinar. They call Interactive Trading Conversations. So a few things about myself. So I introduce myself briefly. My name is Simon Friedman. I'm a senior account manager with AvaTrade, and I've been trading and involved in trading for the past 24 years. I started as a prop trader in New York City, and I did it for about 11 years, pretty intense. So after that, I left the prop trading, and I moved on and started to mentor and educate others. And currently, I'm very happy I have this great opportunity to be assisting our customers at AvaTrade. So that's a few things about myself. The agenda of the webinar, it's very simple. We're here to ask questions, and I'll tell you a secret. I created this webinar just to give the podium to you, in a way to give microphone to you, so you can come here with prepared questions on specific markets and assets, so we can discuss it and we can talk about it and we can try to make sense of things. So because we have amazing webinars, me and my colleagues are doing, and that's works in a way of a presentation, and then there's some time for questions. This webinar is specifically on your questions. So please prepare your questions as you were nice to type into the questions window confirming that you could hear and see me. So that would be great. Just prepare your questions. So you ask the question by typing them into the questions window. I will discuss it, we'll analyze it. Now, a risk warning, you can find a full statement at avatrade.com website. And of course, everything we do here is purely educational. We do not suggest any trades. Social media channels, please feel free to subscribe. You have Telegram, you have X. And as I always say, YouTube is my favorite. There's a huge variety of material there. You have tutorials, you have educational material, you have webinars, including this one will be posted there. So if you are watching this on YouTube, don't forget to click likes if you like it, share with other people, and subscribe and click on that bell so you'll be notified of new things coming. And also for our audience here, the live audience, guys, I've something to ask you. Please be active, ask a lot of questions, because people on YouTube that are watching this, or will be watching this to be more correct, they have no ability to ask questions. So they're just going to be using you and your questions and the answers that we are all getting here. Okay, so it's very, very, very important. All right. Now, what's important, we have up to an hour, and we try to, you try, because I'm not going to fake questions. I'm not going to make it up to you. So you have to come with questions by typing it. Just give an example. Somebody asked about gold, oil, euro, dollar, I don't know, Tesla, whatever instrument that you would like to know, you have questions or you have opinion about, please bring it up by typing it into the questions window, and we'll start working with it. Okay. So far I don't see any questions, which is very concerning, and I hope that it's clear what's happening here. So I'll be waiting for your questions, and as soon as I get questions, we're going to start discussing things. Okay. All right, guys, let's go. I have a question here from Elias. It says, hi, Simon, how do we fundamentally interpret the red folder news on economic calendar, today news, Forex Factory? I mean, it's a good fundamental question. I don't have any specific questions, so I'll be happy to address that. You can't really interpret. By the way, when you open the economic calendar, if you click on each event, thank you, guys. The questions are coming in. Let's pile them up, so we'll be working for the full hour. So you actually, when you click on the specific event, you can see the explanation, and some actually, if you go and do it on our web trader, for instance, and you click on that event, for instance, NFPs on Friday, right? that we're having on this coming Friday, right? So if you click on that, it gives you the explanation. Also, it gives you a little bit of history, and it gives you possible scenarios. If there are more jobs added, certain things usually happening. If not, these things are happening. So uh, you're saying something about the red folder. So I guess you're talking about the high impact events. So there are different levels. There are high impact events are very important. There's less important, and there's even less important. So the ones that move the market, they're usually marked as a very important or priority or whatever the name could be by that provider, because many providers provide that, right? So there's certain news in economic events that play a big role. For instance, later tonight we have uh, Powell speaking, right? The chair of the Federal Committee, and when he speaks, the market is moving. We have, as I said, NFP numbers that we have usually on the first Friday of the month, also moving the markets. The interest rate decisions moving the market. The speeches of the central bankers. I think we had two speeches today of the head of the ECB, European Central Bank. So there's always things that affect the market a lot. There are things that affect the market less. And the best thing, if you never used it, is to learn about it and also to observe it. So if you know that certain events happening certain time, you can just watch the market that you're following and see how it's being affected, how it reacts to it. Now, your question was how to really interpret it. It's very hard because even if you understand it and you know what could be scenario, it's hard to have a specific idea of the outcome because things are sometimes not so clear, and sometimes on the good numbers the market moves higher, on the bad numbers it goes up, and so on, because there's so many aspects involved. For many years the bad news was good news, because as long as the economy is not doing great, the Feds keep the rates negative, right? Not the negative, but only Bank of Japan kept it negative, but low, and they're not going to raise it. And then as long as the news remain bad, we got into another phase, which we're in now. Things are okay, and maybe they'll cut again, and so on. So it's not that clear. That's why you have to understand a little bit of the logic, but that at the same time, you should be prepared that it's not always working in a logical way. Good question, though. Thank you. Okay, so Funny is asking, hi Simon, I have been trading without stop loss. When I place stop loss, I have been taken out of trade, and then trade jumps back up. Lost lots of money like that. I had the stop loss a bit farther, I would have made a profit. Very good point. And again, this is not really a topic of our webinars. This webinar is about specific markets and taking a look at the charts and how things work. But I'll be happy to answer as people are slow today with questions. I tell you from my experience, and you feel that every trader in the world feels the same way. When I started to trade, as I said, I was doing a prop trading. We hardly used any stops back then, because you can call it high frequency trading. We used to trade only on the hotkeys. You spend half an hour setting your 4 or 6 monitors as a prop trader. On Wall Street, you set it up, and then you don't touch a mouse anymore. It's all on the keyboard, hotkeys, buy limit, buy stop, whatever that is. So we hardly use any stops, because I tell you from my experience, I used to trade maybe 250,000 shares a day, 250,000 shares, and sometimes I would get in and out of position within a minute with a few thousand shares. So there was physically no time to put stops. We traded momentum. We had tons of filters, that just shows stocks that are new highs in the day, new lows in the day, all kind of filters. That's what we did setting up in the morning. So there was no stop. But later on, when as I said, after 11 years, I moved away from prop trading and I continued trading. I had this dilemma that every trader has, and it always happens like this. It's you can call it the Murphy law. Every time you put a stop, you get kicked out, and then 3 hours later, you watching your paper profit. You would have been making a lot of money, but you're out with a loss. And next time you think, "Oh, I'm not going to do it," and you do, and you don't place the stop, and then the market goes against you, and then you lose a lot, and then you try to do the opposite and the opposite again, and then you get confused. Like in that classic question, should I stay or should I go? So if you ask any trader that is successful, a day trader or a swing trader, whatever it is, most of them are using stop losses. In this market, it's very important. But there's a stop loss and there is a stop loss, and I explain what I mean. If you just decide that you want to lose, you want to risk $10, and your stop is attached to that idea, you could get kicked out every time, or whatever, $100 depends. So your stop, it has to make sense. What your tolerance? If your tolerance is $10 or $10,000 per trade, some people have that. That's okay, but it also has to make sense technically as well. It has to make sense in accordance to your account. Just give you an example. Somebody trades, I don't know, a $10,000 account, and he tells himself or herself that I'm willing to lose 1% per trade. So if you have $10,000, 10% is 1,000, 1% is 100. So that person says, I'm willing to risk $100 per trade, right? And then he enters the trade and he puts a stop loss $100. He gets kicked out. Then he gets kicked out again. All day he could be kicked out. Why? Because market doesn't care that he has an idea of risking $100. Market is a combination of fundamentals and technicals. So the stop that the person chooses has to make sense. It has to be somehow connected to that specific instrument, and in this way the chart. So if you bought something, I'll give an example. You bought a stock at $10, right? And you want to risk not more than 100. So if that stock was holding at $9 strong support, you know that you're risking $1, right? Then you know that if you're risking $1 per share, and you also want to stick to $100 stop, so you're buying 100 shares. So you bought 100 shares at $10. You put the stop at $9, and then it looks good to you. You feel good about that, and also you look at the chart. For the past 2 weeks, it couldn't break 9.25. So at $9, you probably are safe. Again, there's no guarantee, but you're preparing yourself for the worst. When it hits $9, you're out. So you understand it has to make sense, because if you tell yourself, I want to risk only 100, but then you go and you open 1,000 shares, all right, so you can only afford 10 cents move, not $1. So if you bought it at $10 and the instrument goes to $9.90, you'll be stopped out. And you can do it, between 9:30 a.m. and 4 p.m. New York time. You could be stopped out many times. So you have to take into consideration your account size. You have to have in mind what's the percentage of your equity you're willing to risk per trade. Some people have it per day, per week, per month. I don't know. It's all individual. And at the same time, you have to know that your stop level, in this case from 10 to 9, makes sense. So this way you have better chances, right? So in this case, you calculate, and also if that stock decides to move lower, You know, we all seen it. They went from 10 to $1 to $3. So, you know, you got out at your comfort zone at $1 risk. I hope it makes sense, Fanny, right? Please let me know if it makes sense what I just shared with you. Okay. Alexander is asking, should trend lines and levels be built on candlestick bodies or candlestick shadows? Today we have technical questions. Guys, as I'm answering these questions, does anybody have specific questions on specific assets? That would be great, right? So meanwhile, I'm going to answer Alexander's question. There's no 100% answer to this. You're welcome, Fanny. Some people like to use the bodies. Some people like to use the those you can call them shadows, spikes, tails. There's so many names. It's up to you. I think you need to find what works for you, because, you know, like I said, you ask many traders. What makes probably more sense that the whole candle makes sense, because the body of the candle, it's opening and closing, right? If it's the upside candle, that the bottom is the opening price, let's call it green candle, right? The top is the closing, and then you have tails up and down. It's a high and a low, right? If it's a downside move, it's the opposite. The top of the body of the candle is the opening, the bottom it's closing, and then the tails or the shadows, you call it, are a high and a low. So if you think logically, those the tails and shadows, those are the levels where the instrument actually went to. That means that if the buyers were pushing it and it had a spike up, something stopped that spike in that specific moment. That means that, again, we're trying to be philosophers here, but this is, you know, trying to apply logic. That means that the passive strong seller was there and the buyers couldn't push it past that level. But then if you take a body of the candle, that means that not only was a passive seller there sitting on that specific price, but also there's a group of sellers build up and they push the price. That's why it closed lower than the high of that candle. So you might take that into consideration as a real level, because that's where the majority of sellers moved to. But you would never know if that static or passive seller is still at the top of that candle or he moved together with these guys. That's why I said in the beginning, it's up to you. You have to see what works. You can do either way, right? I hope it works. Okay, guys, we about 20 minutes into the webinar. We had some good questions, technical questions, and I would appreciate if we also ask specific questions on the specific instruments. All right, let's also think about the people on YouTube, as they physically cannot ask questions. That they are here to get information, and you and I have to provide it to them. And I think it's a good opportunity for us to do it. So we still have time, more than half an hour, and we can ask questions about trading assets, instruments that you'd like to know about. Okay, I'll give it a few more seconds. Let's go. All right, I guess we have an audience that don't have specific questions, which is also fine. Okay, guys, so no questions. Thank you for participating. I hope that next week we'll have more questions, and you have a good evening. Take care.